Good afternoon and welcome this afternoon to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Barb Armstrong, who is also a phenomenal educator, 20-plus year veteran of the financial markets, and a good friend. She's there to help facilitate the chat. I'm glad to have all of you here with me today in this discussion, whether you're watching in the live version or in the recorded version. We're glad to have you here. Be a part of the conversation, chatting your questions if you're here live. Leave a comment for us in the comment section if you are watching on the recorded version. And as we get started today, boy, I tell you what, it's been an interesting week. I say that every week, but it has been an interesting week since last week. We've had some downward push in the market. We'll take a look at that. We'll take a look at the current state of our 14-7 days to go until expiration strategy. And I want to talk a little bit about volatility trades, as well as the impact to implied volatility on index options, and a look at a zero DTE iron condor strategy today. So let's jump in. A couple of quick reminders, though. Everything that we talk about is simply for illustrative and educational purposes only. It is not any kind of a recommendation or advice. Remember, the investing involves risk, including the loss of principal. Past performance, no guarantee of future results. Remember that when we talk about equity and index options, they carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Now, one of the reasons why we talk about index options is because European-style index options do not allow for exercise of those options prior to expiration, which removes early assignment risk. But if you are trading American style options and you are short those options, you could be assigned early. In fact, at any time prior to expiration, regardless of the in-the-money amount of that strike price. So keep that in mind. Remember that the Paper Money platform, we're going to be using the Thinkorswim desktop software platform, specifically the Paper Money platform, does not facilitate the early assignment of short options. Now, we're going to look at a lot of different ways to evaluate the market, including probability analysis, technical analysis, fundamental analysis for that matter, are all theoretical in nature. None of those guarantees. Also, remember that when we put stop orders in trades, there's no guarantee as to the execution price of that stop order. And in the event of a stop limit order, there is the potential for that order to be gapped around and not fill at all. So let's jump out here into the Thinkorswim desktop software platform today as we jump into this process. And hopefully we'll be able to answer a couple of questions. I noticed the questions from Legrand here. And the question today that Legrand brings up is the simulated 14.7 on the SPX. Brought in a credit to $2.10. Today is exit day, day 7. The trade is still out of the money, but it's increased in value. So if the price of the option is still out of the money, if the strike price is still out of the money, but it's increased, guess what has probably happened? An increase in volatility. And so we'll talk through that in this discussion. I'm glad you brought that question up. I didn't pay you to ask that question, but it's almost as if I did, because that is exactly kind of the lead into this. Let's take a look first of all at the broad market and kind of see what these indexes are doing. We've got about an hour to go until the market closes. And one of the big influences, I think, today, as probably you are aware if you've not been living in Canada or under a rock. I'm kidding, Barb. I'm kidding. Canada has newspapers too. Is the NVIDIA earnings, and that is likely, not a guarantee by any means, but likely to be a market-moving event, one way or the other. And movement can be sideways too, right? So it could perhaps move the market sideways. Look, I love Canadians. Some of my best friends, Barb Armstrong, are Canadians, and so. Hey, I'm good with that. I'm okay with Canadians. I am not casting aspersions on anyone from Canada or the great country of Canada. All right. Everybody picks on Barb. Yeah, she gives as good as she gets, I'll tell you what. That being said, the SPX bouncing up off of perhaps a little bit of a low. It's moved lower. It came down from and retreated from that 50-period simple moving average here. And in fact, I'm sorry, the 200 period moving average. No, that's 50. Here's our 200. Sorry, I wanted to make sure my colors were the same. But the RSI is starting to tick back up a little bit. And that RSI ticking back up a little bit suggests that maybe there is a little bit of buying stepping in. And, we're up off of the bottom here, a little bit of bottom fishing perhaps, and that move higher. Now, let's take a look at the NDX. And this is very likely the area in which, I'll get payback in Anaheim for sure. Likely to see perhaps a little bit more impact here in the NASDAQ, because that is obviously the home of the trading for NVIDIA is here on the NASDAQ exchange, but it is a component also of the SPX. But seeing a little bit of a bounce here, a little bit higher low, started to push back towards that 50-period moving average, came back from it, retreated a little bit, but the RSI ticking up a little bit. I like that, Barb. All right, and let's take a look at the Russell 2000. The Russell 2000 kind of finding a little bit of a support level here, right around this 2332 mark, bouncing up off of this confluence of support between this diagonal downtrend line and the horizontal trend line that we've drawn in there as a sideways level of support. And seeing that little bit of a bounce, but kind of weakening. A bit of a not quite a long-legged doji at this point, not quite a shooting star, because typically a shooting star would come at the top of a couple of uptrending days, but perhaps a little bit of a move in this bounce possibility. So that being the case, there's a bit of neutral movement, I think, as we look at this in terms of kind of that shorter term time frame. I'm going to come back to the SPX. I'm going to put this on a shorter time frame, on a 5-day, 5-minute chart. And as we put this on a 5-day, 5-minute chart, that kind of gives me the idea that maybe the SPX has been consolidating. And if it's consolidating here, we're kind of seeing that that move in today's time frame, kind of finding this little bit of a support and maybe building a bit of a range right here between about 66.40 and about 66, we'll call it 66.04, but it's really kind of bleeding down a little bit more, about 6,600. We'll call it 6,600 to about 66.50 or so, 66.40, 66.50 on the top side, and it's kind of waffling. And I suggest, I'm suspecting that it will likely kind of go sideways until we get that NVIDIA earnings announcement and really kind of moving that, kind of cranking that movement a little bit. It's likely to move this index somewhat, but it's gone neutral at the moment. You see that the RSI is kind of running into this midpoint where it's been before, kind of right about that 53 level, so neither pushing to the upside nor pushing to the downside. And that would suggest maybe, like I said, maybe some of that neutral movement. But I also want to look here quickly, let's pop over to the VIX grid and take a look at what's going on in terms of the VIX itself. And the VIX higher over the last few days, we saw a spike, but not a spike up as high as we saw back in mid-October, but a spike nonetheless in the last few days, and it's kind of bleeding off. Now, it's staying higher. It's staying relatively elevated. It's kind of staying above this area, that 23 point mark, kind of that 23 handle, where it has been kind of the line of demarcation of really kind of these statistical outliers versus where it's normally stayed. And you can see that it's well above its 30-period moving average in this case, which is interesting because the VIX in and of itself is a 30-period moving average. But volatility still is staying relatively high. But if we look back where volatility was last week, volatility last week when we were together and we put these trades on last week, especially our 14.7 trade, Implied volatility, at least as indicated by the VIX, was down around the 16-17 handle, and it is now still up around that 23 handle. So you've got, a 5-point roughly, or a little bit more, increase in 5% increase in implied volatility kind of across the board. Individually on this strike price, on the strike prices that we've chosen and the dates that we've chosen, expirations that we've chosen, probably even a little bit more increase in implied volatility, given the fact that today is NVIDIA earnings. That's likely to keep implied volatility inflated somewhat. But that's just the reality. It's interesting. Think about wagging the dog, and one stock, which makes up what, 7.5% of the Nasdaq or the S&P 500, is wagging the index basically, and wagging implied volatility in this case. So that has kind of worked against us in terms of this trade. So let's talk about this 14.7 trade before we get too deep into this. Now, I'm just going to say this. This is a strategy that we've been doing for a while, a little over a year now. And only on about 4 occasions have we taken max theoretical loss. On probably 6 or 7 occasions, we've taken some loss in the trade. And the rest of the time, it's generally been a winning trade of some percentage. Now, that does not guarantee that that's going to be the case every single time. Past performance is no guarantee of future results. I just want to be clear about that. But we're in a circumstance where we've kind of got a perfect storm going on. Markets moved down a little bit, so it's gotten closer to our at-the-money position, or put our strikes closer to an at-the-money position, number one. Number two, implied volatility has gone up. So 2 things working against us. So let's go to our monitor tab, and we'll take a look at this trade. So we put this trade on last week, short the 66.25 put, long the 66.05. So 20 points wide vertical spread, short put vertical spread on the SPX. Sold it for $1.90 times 100 shares, $190. Max theoretical loss was about, would have been about $1,800, right? A little bit more than $1,800. Our max loss right now, or our loss right now, if we were to close this out right now, which we're going to do, is going to sit at right about $740. So about half of our max theoretical loss in the trade. So we're not at max theoretical loss. We are at some loss in the trade. Still, some loss is some loss. Now, that doesn't mean that we should necessarily change the strategy. This is tempting. This is really tempting. Now, Barb has an interesting phrase, and I'm supposing that it is perhaps something, perhaps that she, in her Canadian slash Michigan days, heard or has incorporated, and that is put your hands in your pockets and sit on them, or something like that. I'll let her express it. But it is, sometimes we need to just sit and do nothing. And sitting and doing nothing is very difficult for traders. It is very, very difficult for active traders, to be sure, to sit and do nothing, or to stay the course and be disciplined, because we always want to optimize and say, oh, you know what? At this particular case, why don't we just change our strategy because it's doing something different? And so that becomes difficult also. As we do this, then that gives us the idea of maybe sticking with this and being willing to take that some loss. So we're going to do that. We're going to close this down. Yeah, Kelly says, I'm doing it now. Yeah. One of the things I talked about, and I talk about this if you've been in any of our live events, and I'm going to just talk through this as we do this closing order. I'm going to buy this back, and we're going to buy it back for about $7.15. So we're going to take some loss on this excursion. But I'm going to click on confirm and send, and we're going to close that trade down, and we're going to take that loss, and I'm okay with that. One of the things, so some of you know that I have my son and I, my wife and I, my daughter helped too, but we ended up winning the Utah State Chili Cook-Off 3 different years. And we competed over the course of about 6 or 7 years. One of the things that I learned from that in competitive cooking in general, and specifically in chili, is that the years that we didn't win were the years that I tried to change what I was doing, and changing what I was doing in the last minute. Because I thought that it needed to be hotter, it needed to be something, and I started throwing things in. The years that we won were the years that we just kind of did what we were doing. We followed our plan. We put the chili out there and let it be judged. Okay. And the idea being this, that sometimes just following your plan is the case that you need to make. Now, Rita asks a great question. Why did I close it and take a loss when it's out of the money and would have expired? Because I have two things going against me. One, another week of time in that trade, because it still had 7 days to go until expiration. And two, a potential market moving event coming right after the close today, NVIDIA earnings. So taking the trade-off, taking the loss, potentially saves taking a bigger loss if the market moves. I could hold it to expiration, but that's not the plan. So in this particular case, and Jerry's got another way to do it, selling a call spread above, turning it into an iron condor. So let's see how we're going to go about now putting on another trade, because our plan is 14 days to go until expiration, we sell a spread, 7 days to go until expiration, we buy it back, come what may. And we're going to do that. So we're going to go out to the 3 December expiration. And we're going to go to the chart here really quick. I'm going to change my chart to our index grid. There it is right there, index options grid. And we're going to look at the SPX. Now, this index options grid is very simple. Left-hand side is a 1-year daily chart. Right-hand side is a 3-month daily chart. And it's just giving us a more focused view. Left-hand side, I have the MACD histogram. Right-hand side, I have implied volatility for the SPX, which is mirroring the VIX in that short-term move. So here's where we are. Right-hand side, we've got this probability of expiring cone. And one of the things that you may have noticed is that probability of expiring cone has expanded in its width because implied volatility has gone up. When implied volatility goes up, the range of probability, that one standard deviation range, expands. So we're going to respond to that. So here's the one that we just closed. I'm going to remove that line, and I'm going to add a new line. I'm going to go out to the 3rd of December, and I'm going to use the time level tool in the drawing tools. We're going to come right along the bottom here. We're going to go out to the 3rd of December, and it is right there. Click. Boom, set that. That is our line. What that means is now, because implied volatility has expanded, that where we are going to be selling this next iteration of this spread is further away from where the price of the index is now than it was the last time we sold it. So now we're looking at selling down here, and I'm just going to look for that cross right about the 63.55. Now, I'm not too particular, not too precise. I know that I've got $5 increments in my strike prices, so I'm going to find a $5 increment, 63.55, and I'm going to draw a hack there. That's where my hash mark is. That's that level. 63.55 is what we're going to sell. So now we're going to go back to the trade tab. Oh, and by the way, we're still bullish. The index is still bullish. The index hasn't, in this particular case, in that intermediate time frame, has not yet given us a new lower low. That SMA is the 200 period moving average, still moving higher. We're still above the 200 period moving average, so we're still bullish. So we're still selling put spreads. When that flips over, now we're going to sell call spreads, but it hasn't done it yet. So we're going to go to the trade tab. 63.55 is our strike. I'm going to have to add a few strikes here. I'm going to actually add 100 strikes. So that's going to be 50 up and 50 down. And we're going to open this up. We're going to scroll down. We're going to go to our put spread here. 63 Okay, you know what we've got to do? We've got to open this up a little bit more. 63, let's go to 150 strikes so that we can get a little bit more. 63.50. We don't have $5 wide increments this far out of the money. So let's go back to the chart and let's just kind of see where we are. 63.50. It seems to be reasonable. I would rather sell a little bit further out than a little bit further in the money, a little bit closer to the in the money position, simply because it gives me a wider range for the index to move, but it's going to mean a little bit lower premium. So we're going to go to the 63.50, and there's the 63.50. We're going to sell the 63.50 put on the 3rd of December expiration, and we're going to make this 20 wide. So there's 10 wide. There's 20 wide. We're going to go to the 63.30 and we're going to buy the 63.30. Look at that. We're getting about $1.90, bouncing between $1.90 and $2.10 of credit in this spread, but we're further out. So let's see where that delta puts us on that 63.30. Now we're at about the 14-cent delta. Before we were at about the 17-cent delta. Now we're at about the 14-cent delta. That's the expansion of volatility. So think about it in terms of probabilities. That 14-cent delta gives us a probability approximation, says that this strike has about a 14% probability of being in the money at expiration. And remember, that doesn't guarantee a thing. That just tells us the likelihood. Your mileage may vary, as obviously is the case when we get big movement. Okay, so here's Rita the advantage in this particular case, and I'm glad you asked that question. The advantage to selling index options like SPX versus an exchange-traded fund or another equity-based option instead of an index-based option is that those equity options are American style and they can be assigned early. We could take early assignment. Now, is that likely to happen when we're out at the 14 delta? Probably not, but at the same time, it could. So these SPX options do not have early assignment risk. So we're taking one element of variability out of the equation by doing that. That's the advantage. And the lack of complexity when it comes to settlement. If these were to settle in the money, they're going to settle to cash. And they're at the end of the day going to either be worth the cash, the amount of intrinsic value, or they're going to be worth zero at their expiration. So that's the reason for doing it that way. So let's bring our trade back up. And again, not a recommendation by any means, simply an expression of what we might do in using the products that are available to us. So $1.95 credit, click on confirm and send, read through this order. Our max loss in this particular case, $18.05. We're bringing in $1.95 against us, but the probability is that that's where we're going to, that it's going to be out of the money at expiration, likely. Not a guarantee, but click there on Index Options Weekly. We're going to click on send and fire that order off. All right, make sure you are in the December 3rd expiration and make sure that you're showing, in this particular case, enough strike prices that you can get there. Okay, enough strike prices that you can get there. And if you're on the SPX, this should be displaying, right? So you should be seeing those particular strike prices. Yeah. Now, the market's moving, you're right. And so what we've got to look at is the fact that implied volatility may go down. It may also go up. So that may be impacting this. So let's take a look at where it is now. So we sold it for 210, which is cool. We got the 210 for it. Now, this is paper money, and paper money is oftentimes going to fill at the midpoint. But it's now moving down a little bit. So that's exactly what we want this to do. We want this to get cheaper. So a couple of things. One, there's a feedback survey out there in the chat. So Barb's going to repost that. She's also going to pin it at the top. Do me a favor, fill out that feedback survey. Let us know what you think. Help us to make these sessions better for you, these index options webcasts and all of our webcasts. Also, while you're doing that, click on subscribe down at the bottom of the page. That way you're following us over on the YouTube page. It's going to make it easier for you to find it. It's going to make it easier for other people to find the content. Click on the like button if you happen to like this. That's going to bring this content up to the top of the algorithm. Now, Bravo asks the question, why a $20 spread versus a $10 spread? And we get asked this question all the time. I get asked this question every time. Why are we going 20 wide? Well, let's look at the difference really quickly. If we were to go back to the trade tab, let's create the same trade. Let's go to the 63.50 and let's buy the 63.40. Let's make it 10 wide. Well, now we're getting $1.10 of credit, right? So we're bringing in less premium because we're spending more on the 63.40 to buy that protective side or that defining side of the spread. Now our max loss is a little bit lower, but we're bringing in a little bit less premium. And in this particular case, all we're doing is we're kind of now just changing the nature. Now, you can go 20 wide, you can go even wider. Some traders would say, all right, given the fact that this is a 14 delta strike at the 63.50, now it's a 16 delta strike. What if we were to go, say, for instance, 50 or 100 points wide? Let's go to the 63.50, sell the 63.50, and then buy the 62.50. That's 100 points wide. Now we're bringing in a much bigger credit, but watch what happens to our max theoretical loss. It goes to $9,000. So this is how you kind of adjust it, right? You have the flexibility to be able to do this at whatever spread width you want to do that's available on the option chain. Just recognize what that's going to do. Now, it's also going to change the net Greeks because the $10 wide spread is very likely going to have greater sensitivity to implied volatility changes, which means that implied volatility going up is going to have a bigger impact on that trade negatively. So you manage your net Greeks as well, right? The same way and in doing this trade. Yeah. So Jerry, that's something to think about, is the change in implied volatility sensitivity if you do a narrower spread versus a wider spread. So just a thought process. And again, you can do this. So we started by doing this at 20 wide. We've kept it consistent again with the plan at 20 wide vertical spread. Try it out. Experiment with it. All right, let's do this. Let's now come back over here and let's take a look at the chart. And given that kind of neutral movement that we were talking about, and given that neutral movement, what I'm going to use here for this next strategy is XSP. Now, XSP is the micro index that follows the SPX. So same movement, it's just a tenth the size of the big index, which means that its strike prices are a tenth. The premiums are going to be a little bit lower as well, but movement, implied volatility, all of those other things are going to be very, very similar to the SPX. So my thought was, as we look at the XSP, the smaller index. Now, it used to be that the XSP had a little bit of a liquidity challenge, meaning there weren't as many people trading the XSP as there were trading the SPX. But again, this is European style. So there seems to be some migration from American style options trading this movement to a European style index that is more in line with the size perhaps of some of the other equity based products that follow that movement. So my idea here was we're likely to see through the end of the day that neutral movement that we were talking about, right? The range of movement here that we had kind of defined earlier on in the discussion, kind of in this area right there, right? 60, 66, 50, and 6,600, kind of that 50-point wide range. Hey, Brett, how you doing? All right. Now, look at where implied volatility is. Implied volatility is fairly high. So what I did earlier today, when the market was really kind of consolidating here and implied volatility was relatively high, I went out and I sold a 0 DTE, today's expiration, which means that this trade is in its last day to go until expiration, which means that at the end of the day, it's going to expire worthless or it's going to be worth intrinsic value. And I sold this spread, this iron condor. So I sold a call spread above and a put spread below. I sold that spread for 99 cents. Let me show you what I did. I went to the trade tab for XSP. And I went to today's expiration, 19 November. Now, if you're going to trade a 0 DTE expiration or 0 DTE option or spread, recognize that there are some challenges and there are some significant risks in doing that. At the same time, though, recognize that every option eventually becomes a 0 DTE option on its last trading day. So understanding it is better than fearing it, I think. So what I did here is I created at about the 25 delta, I created an iron condor. And that iron condor was selling a put spread at about the 25 delta and selling a call spread at about the 25 delta, expecting relatively neutral movement. As a matter of fact, I put it on the Analyze tab. And on the Analyze tab, this line right here represents the current trading price of the index. But this has that familiar graph shape of an iron condor. Notice we are right up against our short strike on the call spread. So we are still in the area of getting max theoretical gain, theoretically, if we were to just let this go all the way till expiration. But it seems to be moving up a little bit, which means that, and you can see that it's just barely now starting to tick over the edge into that some loss range. So what we could do right now in managing this trade is one of two things. We could simply take the whole trade off as a whole. We go back to the monitor tab, and it's currently trading for 66 cents as a whole. We could close this down, and we're getting about 33 cents or so for this spread, what we get to keep in the trade, which is about a 30% return on the trade. Okay, all right. Maybe we can do a little bit better, but notice something. Notice that our put vertical, if I do this, if I right click and I go create closing order and I get to the position dissector, if our call spread is being threatened because the index is going up, that means that our put vertical side of the iron condor is getting into a position where it is becoming near worthless. So look at this. We could buy back because we know that this is going to go away at the end of the day anyway, because this is 0 DTE expiration. So there's no reason, perhaps, in this case, to hold on to this, because it's not going to come back theoretically the other direction. It could, but if we can close down the put side of this equation for a penny and take that risk off that it slams back down at some point because of news or whisper numbers or whatever else could happen, okay, I'm going to sacrifice a penny of what I brought in to close down the put side of this equation. So what I'm going to do is I'm going to buy back the short put vertical for a penny. Buy it back for a nickel and avoid the pickle. Now, it's a penny in this case, so it doesn't... Do we even use penny? We don't even use pennies anymore. Click on confirm and send, read through the order, make sure that that's what we want to do. We want to close this down and eliminate that. Make sure that this is to close. Click on send and fire that order off. And theoretically, if there's liquidity there, we're going to close down that side. And it depends on whether or not there's liquidity. This is one of the challenges of 0 DTE trading, is that you start to get a position that it moves far out of the money and you start to lose liquidity in the end of the day because somebody's got to buy that back. Now, we could widen it out. We could give back a little bit. That's the challenge. So we go back to the monitor tab. We go to our working orders. Here's our order to close. Right click, cancel, replace that order. And we could open that debit up a little bit to 3 cents or 4 cents. So widening this out, we're going to bump this out a little bit. Remember, this is paper money, so fills might be a little different in a live trading account. But we're going to look at closing this down. We're going to put that back in our index options and click on send. Fire that order off and see if we can close down that side. We might not be able to. That is a risk of trading 0 DTE options and 0 DTE spreads, is you might not have liquidity, especially if they are far out of the money, to be able to close the trade down prior to the end of the day. And you could run into that risk. So properly warned you be, says I, in this case, making sure that you understand that that is a potential risk in this case. Now, the other thing to think about is now, if we were to close that down, what we were then left with is a short call vertical that's just barely starting to get threatened a little bit. Just barely starting to get threatened a little bit. Now, we haven't closed down that side yet, but we could. So what we're going to do, what I may do in this particular case is, let's see if we can close this whole spread down. So what I'm going to do is I'm going to right click and I'm going to cancel that order because it's not working for us to get out of that short side. The one that's not being threatened, the one that's essentially become worthless. I'm going to right click. We're going to create a closing order. We're going to buy this back. And we're going to see if we can work this a little bit. I'm going to see if we can work this down to about 70 cents. We'll see if we can get out of the trade. Now, we could leave it till expiration, which is at the end of the day. Remember, the last hour of the day gets very volatile. We're now in that last hour of the day. We got about 35 minutes or about 25 minutes left to go in the trading day. This is starting to become a little bit more volatile. So I'm going to click on send. We're going to see if we can close this trade down after reading through that order, making sure that we understand the risks. We'll see if this order will fill for us, and it might not. Again, one of the risks. Yeah, you could close. You're right. You could buy back the short. Greg, you could buy back the insides of the Iron Condor and leave the longs out there as lottery tickets. Virtual lottery tickets, not real lottery tickets, and they're not like lottery tickets. But sometimes that's referred to, those long shot, low probability, high payoff if they get hit option trades, sometimes referred to by market participants as lottery tickets, not suggesting that there's a relationship between trading an index option and a lottery ticket or in any way associated with gambling. All right, so this is one of the challenges. And I wanted to demonstrate this simply for this particular reason. And this is, to be honest, this is the reason why we moved this webcast to later in the day, so that we could see these things playing themselves out in real time. So what we can do is perhaps come back up here, and we might have to bump this order a little bit, because look at what's happening. That implied volatility has bumped up yet again. The market really hasn't moved that much, but notice where the market is at the moment. If we open up the lock, it's at $1.09. More than what we were paid for it to begin with. Okay. Now, Tatiana asks a question. We don't have a risk of early assignment because these are index options and they're European style. They can't be exercised until expiration, so we don't have that risk of early assignment, which is, again, the reason why these become attractive to some traders in that expiration, in that 0 DTE timeframe, because you don't have that early assignment risk. All right. Boy, and we're now getting plowed over as this starts to move. So in this particular case, right? In this particular case, that's starting to move. The market is, we go back to the chart, and we can see that the market's starting to run back to the upside into the close. So we might not get it. Kelly says last hour trades from 0 DTE can be volatile. And we can see that happening if we go back to our Analyze tab. You can see where that is. We're now just barely outside. So I'm going to look at closing this trade down and look at just saying, hey, I was willing to take the potential loss in this trade. I can get out of the trade at a small loss. Getting out of a trade at a small loss is better than getting out of the trade at a theoretical max loss. So I'm going to go back to the monitor tab. We're going to right click, cancel and replace. We're going to open up our lock here and see if we can get out of this trade. Now, we could just let it expire. But again, there's a lot of time. There's still 20 minutes to go between now and the expiration. And there could be a fair amount of change in the market between then and now. And I don't want to take that max theoretical loss. So I'm going to look at closing this trade down. We're going to put it back in our index options, click on send. We're going to fire that order off, and we can see if, again, if we can get out of this. Risk in putting on a 0 DTE trade, especially a four-legged trade, is that we might not be able to get out. So Tammy asked a question. Tam and Honey asked the question, what's the advantage or disadvantage of trading XSP versus an equity product? No early assignment, because it's European style, cash settled, and what Barb just said, there are some other treatments in terms of tax and others. We're not tax advisors. Don't even play them on TV. But we can direct you to some resources. Good opportunity to talk to a financial advisor at the branch or a financial consultant at the branch for some of those resources. But this is a strategy, once again, now we could have gone further out and made this a wider iron condor. We would have brought in less premium, and potentially our max theoretical loss may have been larger. So we've kind of balanced. It's always in that balance. Always in that balance. All right, so we'll see if this trade closes. It may not. We may not get out of this trade. So I think this is a good illustration of some of those risks. You can see that the market's kind of pulling back a little bit. So we're now kind of bouncing around right around that short strike. So we're willing to pay to buy this back out to that $1.50 for the spread times 100 shares, so $150 to get out of the trade. We brought in 99 to begin with, so we're taking a fairly small loss if in fact it does fill. But again, there's got to be liquidity there. So something to pay attention to as this market moves around a little bit. All right. So what I'm going to do now is just kind of quickly review what we've done. Let's go back to our monitor tab. We looked at our 7 days or 14-7 strategy, and that was this one right here. Sold it for 210. It's now trading at about 215 to 220. So it's kind of going against us, but again, that's because the market's moving a little bit and implied volatility has increased as we've gotten closer to the end of the day here, right? Now, DGen Viking asks the question, would we put a stop loss on this? And here's the reason why we would not, generally. Now, you could do whatever you want, but here's the reason why we generally would not, and that is because these can be volatile, especially early in the morning. If we put a stop on, we could get hit and then have it go in exactly the other direction. So we typically some traders will manage vertical spreads like this, defined risk trades, by managing to theoretical maximum loss and adjusting position size to that, as opposed to using a stop. Okay? Yeah, so you can't get out. It's a lead condor. I like that, Eric, very much so. I like that. It's a lead condor. It's just kind of sitting there. Now look, here again, once again, look, here's where this order is. We're willing to pay $1.50 per share times 100 shares to get out of this trade, to get out of this iron condor. It's trading at 56 cents at the mark price, but we're not getting filled. It's not getting filled. That would tell you that there is perhaps a widening of those spreads, implied volatility likely to be moving around a little bit. So if this expires at that point, if we don't get out, this is going to expire at the end of the day. And it's going to expire to intrinsic or zero. We hope that these spreads expire to zero. If they expire to intrinsic, we know what our theoretical max loss is because this was a risk-defined trade. And we're okay with that. We position sized according to that risk definition and that max theoretical loss. So good illustrative example, I think, of the difficulties sometimes in getting out of a zero DTE trade. But some of the reasons why we might trade that is an expectation of directional movement or non-directional movement. And it is a strategy that's becoming increasingly more popular. That doesn't mean that it's recommended by any means. So that being said, that's what we've accomplished today. If you want to learn a little bit more about this, come over here to the Trader Talks webcast page. By the way, click on subscribe, fill out that feedback survey for us. Let us know what you think about this webcast. But again, you can come back here, Iron Condor. If you want to learn more about managing iron condors, there's me talking about iron condor management, zero DTE. That was a month ago. Here's Barb Armstrong talking about real-world examples in trading a smaller account of iron condors. Brent Moores, Barb Armstrong, Connie Hill, Cameron May, a lot of the webcast coaches talking about iron condors. So some good stuff. Fill out that feedback survey. Thanks, Barb, for helping out. Thanks to all of you for being here. Barb and I are going to be in Anaheim, so I hope you're coming to visit us at our event in Anaheim, our Market Drive event. Then we're going to be in Houston. Then we're going to be in Miami. So I am out. I'm getting in the car, and we're heading out here in just a little bit to drive down to Anaheim and then spending a little bit of time at Disneyland. So Scott Thompson's coming up next with Stock Investing for Beginners. We'll see you soon. Take care, everybody. Bye-bye.